hello and welcome to this week's Minds and Money 5 at 5 show, which is part of our Minds and Money May Roadshow. And today is sponsored by Celsius Resources and Australian Vanadium, and is also brought to you by the Resource Global Network. As mentioned, the Minds and Money May Roadshow runs over the next 3 weeks. Today, the 13th of May in the EMEA time zone, and the 18th of May in the Americas time zone, where we have over 70 mining companies and 400 investors registered. For those of you attending 5 at 5 for the first time, the aim of 5 at 5 is to maintain engagement between investors and miners through a lively interactive format whilst we wait the return of physical events. A few admin announcements before we start. You can either submit questions via the chat function, which is at the bottom of the screen. I've just posted a message in the chat function, or you can ask your questions live by asking yourself to be unmuted, and one of my colleagues, either Elaine or Simon, would go and unmute you so you can ask your questions live. For today's show, we have a great lineup of guests. They are Blair Sargent, Executive Director Corporate of Celsius Resources, listed on the ASX. Vincent Algar, Managing Director of Australian Vanadium, also listed on the ASX. Warren Gilman, Chairman and Chief Executive Officer of Queen's Road Capital, and Cathy Moises, Executive Committee Member of Argonaut Fund. So for the opening section, I'd like to discuss what mining news stories have grabbed the attention of some of our panelists this week. Perhaps sort of turning to yourself first, Warren. I was going to read out your sort of bio, but it's quite a long bio. I know I saw a recent interview that you were described as a living legend within the mining industry. So I don't know as to how you would best go and describe yourself, but you've obviously had an illustrious career, worked at CIBC, served as an advisor for many of the largest mining companies, BHP, Rio Tinto, Anglo American, the list kind of like goes on. But what's been kind of catching your eye in terms of mining news stories recently?
Well, yeah, you can refer to me, Andrew, as legend. I like that. Legend's good. My mom would like it if she was still alive, so I gotta jump onto that one. But the thing that has really got me, not just overnight, but over the course of the last 6 months now, has been, the radical change in the uranium sector. And may not be any surprise that I'm mentioning this, because it's my company, Queen's Road's largest exposure. So yes, guilty as charged for talking my own book, but also that's because I'm a believer in my own book. Now, the interesting thing is that the equities have just been on a wild tear, just an incredible tear. And yet the uranium price has really not budged. Yeah, it's gone up and down a little bit. It's moved around, and it's being moved for various reasons. But the equities have just taken off, and they're all anticipating the inevitable big move in the uranium price. So when the big move in the uranium price actually does occur, you got to wonder where we're going to go in the equities. And of course, the latest thing last night that caused everything to go to new highs was the realization that Biden not only endorses nuclear, but he's now building nuclear tax incentives into his multi-trillion infrastructure budget. So there's actual monetary stimulus being applied to the US nuclear industry, which, let's face it, is still one of the biggest sources of uranium demand in the world. So that, of course, has caused all sorts of tremendous bullishness out of the US, driving US and, to a lesser extent, rest of world uranium producers to new highs. But it's incredibly exciting times, and we're living through these new developments on a daily basis, which the market is taking as being very, very optimistic signs.
And this is a follow-up. What's been the catalyst? Because I mean, I know that I've been with Minds and Money since 2014, And I'm taking a slightly like cynical view, but like every year since 2014, people say like this is going to be a big year for uranium, and it just never quite happened in 2015, 16, 17, 18, etc. Is the catalyst the Biden presidency, or is it like something else?
That's a really good question, Andrew. And obviously, the disconnect between the equities and the actual underlying uranium price needs to be explained, is difficult to explain, impossible to explain. So everyone would have a view, everyone has an opinion on that. My view is that the world has changed, and it's literally been a change in the last 6 months, reflected by the Biden administration, but not caused by the Biden administration, just reflected by it. And that view is that nuclear energy, let's face it, not just since Fukushima, but even since Chernobyl, even since 3 Mile Island, has been on the defensive, has been a bit of a pariah, has been definitely subject to not in my backyard. And we've seen countries like Germany decide to exit the industry in its entirety. And yet in the past year, everyone has realized, and now it's become almost globally accepted, that nuclear is absolutely required if we're to meet any climate change commitment goals from Paris for 2050. It's absolutely required. Therefore, not only we're going to build more reactors, we're going to shut down fewer of them, and we're going to extend the lives of all of them. So the world has changed, and that has literally been a phenomenon of the past year to even 6 months. And I think that's what's driving it, Andrew. The uranium price will inevitably catch up, but people's view of the nuclear industry and therefore uranium stocks and their future has fundamentally changed.
Mm-hmm. Okay, thank you very much for that, Warren. I'm bringing in Cathy Moises, and just to give a bit of a brief background for those of you that haven't met Cathy before. Cathy's had a very illustrious career with a number of Australian stockbroking firms, including Macintosh, County Securities, and Evans and Partners. More recently, she was with Perseus Mining, running their business development and investor relations, and she's also worked at Patterson Securities before a current role at Argonaut Funds. Obviously, like a key trend that Warren just talked about is uranium, and that's been a key news story that Warren's seen over the course of the last 6 months. If you were to pick out one key mining news story or trend that you've seen, or pick out a couple, which ones would you be picking out, Cathy?
Thanks, Andrew. I think global warming is the focus, and one of our focuses is on the EV sector. And I guess the other focus at the moment is having covered the resource sector for over 30 years, it's the first time we've really had a moment in the sun really over that period, and a lot of the prices are getting pretty hot. And you've got to be quite nimble at the moment and probably chase down the chain a little bit. I mean, some of the major names have really had a very good run already. So if we focus on EV, there's a number of obviously different commodities within that sector. Rare earths is a sector which, as a broker, I was very close to and covered it. And I don't know whether many people on this call follow NdPr, but the price has been fantastic. And we've seen, particularly in Europe, car manufacturers such as Volkswagen really pushing to get a crossover to electric vehicles by about 2030. And you're going to see a very significant rollout, I'd say, over the next 5 to 10 years. There really isn't the production availability, particularly outside China, to meet this demand at the moment. And unlike your good old Aussie gold company, where you can get a mine up potentially for 100 to 200 million and commission it potentially within 6 months, these things, if you produce to the final product, are multi-billion-dollar cost capital entries and 3 to 5 years potential commissioning. So as the price rises, you're not going to get 20 other companies rushing in to fill the void. So I think we're in for a really interesting ride on those rare earths companies. And as a background, I guess the Argonaut Fund, which I'm on the executive committee, has only been in existence since January 2020. And to give David Franklin, who's the head of this resource fund plug. We're up 48% over that time, and granted, it has been a great time in the resources sector. But I think for a fledgling high conviction fund, that's a great outcome. He's focused also on the lithium sector and has a number of names, again, with the EV theme in mind. And I guess where to stay out of, clearly with sustainable and global warming, we're staying out of the fossil fuels on that end. We feel that's quite worrisome at the moment. And potentially the iron ore's had a great run, so maybe take a few profits on the larger names there.
And just as like a follow-up question, I mean, certainly on this side of the world, I guess the key buzzword in 2021 is decarbonisation. And obviously that sort of like resonates, I guess, with some of the comments that you've just made there, Cathy. You mentioned a bit briefly about Argonaut funds. Can you talk about some of the key sort of investment themes that you're particularly that you're particularly tracking at the moment? You've obviously mentioned sort of EVs, but I'm interested as to what percentage of your stocks are actually invested into sort of battery metals and throwing the EV investment thesis, and then like what percentage of your holdings are like looking at other areas?
Okay, well, we tend to have 10 to 25 stocks. We've actually got two funds. We've got the main fund and a smaller fund called the Perseus Fund, and we've got about 10 million across the two. And it varies for many times, but at the moment, so the key investments we've got are a few gold stocks, such as Capricorn Resources, and then we've got quite a few smaller golds outside that. On the base metal side, Gold Road, sorry, not to mention Gold Road. On the base metal side, the key holding would be Independence Group. And then within the lithium space, we have Infinity Lithium and a few other names there. And generally would be invested up to about 80 to 90% of the fund, and it's fairly equal weighting between those sort of commodities. We tend to have a very balanced portfolio approach, that we're not going to go out on an absolute limb and have, say, 60% of our FUM in one particular sector.
Okay, and just switching back to Warren Gilman, I know we didn't talk too much about Queen's Road Capital when we were first talking. Can you just give us a bit of a synopsis as to who Queen's Road Capital are? So I think you set it up like 2 years ago, and what your sort of investment strategy is.
Sure, Andrew, thanks. Yeah, it's only been a year, believe it or not. We've only been in existence for a year. We are a Cayman-based, Toronto-listed mining investment company that's run and managed out of Hong Kong with almost all Aussie shareholders. So we're certainly a global platform, and we invest in the sector just the same way we did when I used to run CEF, which did the same sort of thing on a private basis for Li Ka-shing here in Hong Kong, which I did for about 10 years. We take big bets, so very concentrated. We just announced our fourth investment a couple of days ago in the copper sector. We focus on income generating investments. So we do our own structuring. We invest in converts or structured bank facilities or royalties. We don't do straight equity. And we focus on quality of deposits. So incredibly high quality deposits. Our shareholder base is dominated by household names in Australia. They're not particularly well known in Toronto, which is kind of interesting, but Andrew Forrest is a 26% shareholder. Jack Cowan, Hungry Jack, is a 26% shareholder. Brett Blundy, John Singleton, various other Australian self-made billionaires in that list. They're all founding shareholders of Queen's Road, and that's our shareholder base. Okay,
thank you very much for that. I think with that, then let's move on to our first mining update. Blair Sargent is an experienced mining executive, having been the former founding managing director of Lima Resources Limited, an ASX-listed coal exploration and development company, as well as the former finance director of Coal of Africa Limited, who together with the managing director grew the company from a sub 2 million market capitalization to over 1.5 billion at its peak. He's now executive director of corporate of Celsius Resources, who, as I mentioned earlier, are listed on the ASX under ticker CLA. Blair, the floor is yours.
Thank you, Andrew. So just a bit of a background on Celsius, and in particular, Celsius just completed a acquisition of a portfolio of copper gold assets in the Philippines, and that was crystallized in early February. And just to give you a snapshot of that, which is definitely the focus now of the company, those assets and the portfolio of assets were previously owned by Freeport, who most listeners would probably be aware is one of the biggest, and for a while was the biggest copper producer in the world. And they invested over $45 million into the Philippines on these specific assets. So we sort of find ourselves in a terrific position to benefit from that historical exploration spend by Fort. Our flagship project is what we refer to as the MCB Copper Gold Project. We just issued recently a maiden JORC resource, which is over 90% indicated, over 3 million tonnes, running at about 0.48% copper and 0.15 gram gold. And within that, there is a high-grade core, which is the focus of our current efforts, of around 90 odd million tonnes at 0.8% copper and 0.28 grams a tonne gold. So it's, it's got the scale and it's got the grade, looks really good, and certainly a lot further advanced than I think what the market currently appreciates, which again just reflects the fact that Freeport had spent, around $14 million on this particular asset and drilled over 22,000 meters. At the moment, our focus is an infill drilling program, which we kicked off recently, and we've also kicked off a scoping study on the first project, and we're very much focused on its rapid development as quickly as we can. We like to see ourselves not as an exploration play, but very much a development story. And we, in addition to that asset, we've got another 2 copper gold assets in the Philippines, and one we know not much about, but the other one we've got a lot of information as well, courtesy of Freeport, over 25,000 meters of drilling on that project as well. Not quite in a position to issue a result yet, but the process there is we'll renew the permit, do a small exploration program to put ourselves in a position where we can in fact issue a maiden JORC resource on that project as well. Management wise, I think it's a fantastic team. I'll put myself aside in that. What I'm referring to is actually the guys that have got an incredibly deep, long history in the country that we're talking about, the Philippines, including the former director, senior vice president of the Philippines' largest gold producer, which is a company called Atlas. And I'll talk about that a little bit later in terms of some of those people that are involved. But a deep experience, and it's particularly important in the Philippines to have that. It has a bit of a reputation as being a bit of a difficult jurisdiction. I don't think it's true, but nonetheless, what is true is you certainly need people that understand that environment. And Celsius, I think, has done really well to put together a team that has 30 plus years of experience in country. In addition to the copper gold assets, we do have a legacy asset, which is a cobalt asset. Not a bad place to be either, mind you. At one point, Celsius had a market cap of over 150 million on the back of the cobalt asset. That was in a different pricing environment, of course, that's acknowledged, but nonetheless, it does look fairly interesting. We haven't sort of decided exactly what we're going to do with that asset because the new board members are still wrapping their heads around exactly what it looks like. So we're sort of subjecting it to a bit of a technical review with the outlook being, let's see what that review says, and then we'll make a decision around what we should or shouldn't do with it. But it certainly looks interesting. And as I mentioned, the other guys, Warren and Cathy, were talking about, climate change and global warming and the transition to net zero carbon. And obviously cobalt is forecast to play a very, very big role in that transition as a result of being a critical element in batteries, certainly battery technology. So all in all, we're sort of very happy about where we find ourselves. Copper's a great place to be. The outlook is incredible-ish. Price has already doubled, pretty much doubled anyway in the last 12 months. Cobalt assets still in there as well, and we'll look to do something with that. So that's kind of a brief little snapshot, but very happy about where things are at.
Okay, thank you very much for that. And I should say to our listeners who obviously feel kind of free to ask me questions by posting them into the chat box. I think probably just turning to our two investor guests first. Perhaps if I can turn to you first, Cathy. Do you have any sort of thoughts on Celsius resources or any questions for Blair? Oh, we just need to unmute Cathy. So it's unmute Cathy and then see. Okay, yeah, Cathy, I think you're now with us again. Sorry about that.
Lucky for that. Blair, I've covered a few companies in the Philippines in the past, and clearly there's been some issues with some open pit mines over there, and there's been some closures. What's your opinion on the current political situation over there and the mining jurisdiction?
Yeah, it's interesting. I mean, I think you probably would be aware, and others may be aware, that at some point during the current president's tenure, he sort of mentioned that he had a bit of an adverse position when it comes to open pit mining. But like all things, politics is politics, and the reality is often a slightly different thing. So what I would note is this. Where we find ourselves at the moment is the president has recently issued a decree which is overturning a previous sort of ban, as it were, on new mining title. And that's not something that he put in place. That's something that the previous president put in place. So first things first, he's recently overturned that, which obviously is a good sign. But the other thing to note in relation to open pit mining, and to your point there are lots of existing open pit mining operations in the Philippines. You're probably aware that they are number one or number two largest producer of nickel in the world. You can't be that without having a pretty big mining industry, and that includes open pit mining. And as I mentioned before, one of the members of the team is our chairman, Martin Buckingham. He has been a director of a company called Atlas Consolidated, which is the Philippines' largest copper producer, and their operation is an open pit mine. So it's an interesting situation. I think the president's main point when his off the cuff comment regarding open pit mining was he really feels that there's been a bit of a disregard to basic environmental principles and adherence by some and certain mining companies in the country. And that's something that he's not too fond of, which is completely understandable. I think any modern mining company, even over the last 10 years, I think things have changed significantly, and adhering to global standards when it comes to environmental practices is par for the course. Nobody in the mining game, I think, anymore, thinks or looks to undertake any mining operation without adhering to those basic principles. So we sort of think that with the new decree that was recently issued, and I think combined with some good mining practice, particularly from Aussie mining companies that are operating in the area, I think you'll find that there will be new open pit mines happening in the Philippines over the coming years. It will be a lot harder than an underground operation. There is no question about that. But I think that you can expect to see a freeing up, as it were, of open pit mines in country, but with an overriding principle, without a doubt, that they must adhere to the highest of environmental standards and compliance. Otherwise, there is likely to be further issues.
Thank you, Blair.
Okay. And then just a question has been sent in from the audience, from John Zakovich. With your assets across various jurisdictions, where does Celsius priorities presently lie?
Good question, but simple answer. 100% focused on the copper gold assets in the Philippines. As I mentioned, they're a lot further advanced than the other assets in the portfolio. We're very focused on trying to bring the first project into production as quickly as we can, but obviously following due process. But there's no doubt whatsoever in my mind that the team is very much focused on the copper gold assets first, and probably the cobalt asset is a distant second, although recognising that we're the new board members, of which there are 3 of us, are still getting up to speed on that particular project.
Okay. I'm bringing in Warren Gilman. Warren, do you have some questions for Blair?
Yeah, I apologize for focusing on the country rather than the ore body, Blair, because as I mentioned, we're all about ore body. But when it comes to the Philippines, it's hard to get past the country discussion. When I did this for Mr. Lee, he's incredibly geopolitically risk averse. And he said, Warren, now granted, it was effectively a family office, so we're investing, as he would say, look, Warren, I've got more money than God. I don't need any more money. What I want to do is make sure that my grandchildren are in good shape, and I won't be here to look after them. So Warren, your job is to invest in mines that are going to be around when my grandkids are around. But not only that, you need to be confident that we will own them when the grandkids are around. In other words, over the course of the next 2 generations, someone or some government doesn't come by and decide to take them themselves. And therefore, there are certain countries that we couldn't go to. And in my previous life before that, as a banker, I did a fair amount of work in the Philippines and got to know the sector and the players very well. It certainly was a country with its challenges. And you had to not only know your way around the country, but you had to protect yourself. So, sorry, a long-winded diatribe to get to the question, which is, when you see what's happened to Oceania, for example, where, they've got the ore body, they've got the mine, and then all of a sudden they don't. How do you defend yourself against that? And the second part to that question is, once you develop these ore bodies, which absolutely geologically very attractive, and the grades you've just described, Chile would be very, very jealous of those grades. So geologically, the Philippines is a great magnet. But once you develop that deposit, or once you define that deposit, would Celsius be looking at bringing it into production themselves, or would the goal be to try to sell it to someone who perhaps has more political influence in the country?
Yeah, thanks, Warren. I mean, the issues around the Philippines and perhaps their reputation is certainly not lost on either myself or the other board members. But I think what I would say is, having spent the best part of 10 years in Southern Africa, and perhaps my risk appetite is slightly different, but it sort of strikes me that things are always as they seem, and the most important aspect in jurisdictions such as the Philippines is, as you mentioned, it's having the people that know their way around, but not only that, additional issues that are ancillary to that. But what attracted me to this particular entity, the portfolio of assets, was in fact the team that was coming with it. And from my perspective in particular, when we're talking about our chairman, who's a fellow by the name of Martin Buckingham, when you look at him and his experience, specifically in the Philippines, you're talking about the largest copper producer. He is and has been living and breathing not only the jurisdiction, but all of the issues that go with the jurisdiction. in a company which has just been producing copper without interruption for the best part of 30 years. So it's very difficult, despite its reputation as a nation, and despite entities like Oceanic Gold and what's happened to them. I look at Martin and I look at what he's achieved and what he's continuing to achieve in country, and it's really hard to not listen to what he's got to say. And he feels very confident about his ability, as well as some of the other team members, to execute on the back of these assets, which, as you've pointed out, on the face of it, look really solid from a geological perspective. And in addition to that, there's two other team members, which one of them is an Aussie engineer and the other one's a Filipino, and they've just come from Tampakan, which is probably a project you're familiar with. It's probably one of the largest undeveloped copper gold projects anywhere in the world, let alone the Philippines. It's, 15 million tons of contained copper and 18 million ounces of gold. And those two individuals, Peter Hume and Nene, that I'm referring to, have come from that particular project. And in that case, they had to do over 150, local communities, which is a big deal. And that in fact is a bigger deal than the government. Without the consent of the local communities, you're not going to get anything done in country. And that particular project, as I mentioned, over 150 different communities, and Peter and Nene managed to essentially get the consent of all 150 different communities. So again, I'm not trivializing points at all, but what I am certainly saying is I'm willing to back the team in question here because of the depth of their experience. And it's very, very hard for me to question it when they have been delivering like they have been in country for as long as they have. As for governments changing their minds at certain points in time, there's really not much one can do about that. But as I mentioned as well, I still think that the Philippines suffers a reputation which is not quite as deserved in a negative sense as they've got. And I say that because it's hard to imagine how you can be the biggest producer of nickel in the world without a functioning mining industry. There is plenty of good quality mines that are operating and they're not all being shut down. So I think sometimes some of these organisations, we don't know what's happened exactly. All is definitely not what it seems. I know that for sure, but I'm going to back the team here, and certainly in the context of the president issuing the recent decree, there's no reason on the face of it why we can't do what we're hoping to do, and that's bring this first project into production.
Thanks, Blair.
Okay, thank you very much for that. I think in the interest of time, we just need to move on to our second mining update. You will see just before we move on, Blair, I think there's a question or comment about cobalt and the price of cobalt in the chat section. So maybe you just want to kind of answer that question or that kind of comment into your own sort of time. But just to move on to our second mining update, Vincent Algar is a geologist by profession with over 25 years experience in the mining industry, spanning underground and open cut mining operations, greenfields exploration, project development and mine services in Western Australia and Southern Africa. Vincent has significant experience in the management of publicly listed companies, which includes the entire compliance, marketing and management process, and encompasses the development of internal geological and administrative systems, exploration, planning and execution, plus project acquisition and deal completion. Vincent is here today to talk about Australian vanadium. Vincent, the floor is yours.
Great, thanks very much, guys. My voice is very scratchy, so apologies, too much talking, it goes with the job. Just briefly, I'm going to give you a quick update about our company. So I'll start off with the market. Let's talk a little bit about vanadium. What does vanadium do? What is it for? Well, in principle, we have a market that is pretty much driven by the steel market. So we add vanadium to steel, we make stronger steel. If we use more vanadium, we need less steel to build buildings. So that's an important thing to remember going forward here, that vanadium does have a green input, and we've actually recently, as an industry, had some research completed by Texas A&M University that supports a significant leverage of using vanadium in high strength microalloyed steel. that actually has a huge carbon footprint consumption. If you look up Texas A&M University and vanadium, you'll see they're doing fantastic work there. But the research that's come out is part of a life cycle assessment that we as an industry are doing and supporting. But that has direct impact on me as I develop this project at Australian Vanadium. So the other parts of the vanadium market are centered around the titanium and chemical markets and specialty chemicals. Those are driven by high purity products that end up in microalloy titanium aluminium alloys, end up in jet parts, turbine blades, landing gear, rocket nose cones, golf clubs, tennis racket handles. Take your pick, specialty steel that does the job. But most important and most interesting for all of us is the growth of the use of vanadium in energy storage. Now, there's two aspects to that. The current and most in our face, if you like, is the commercialization of the vanadium redox flow battery, an Australian invention, now being produced by over 20 or 30 companies globally. Quite a few. I say that number very vaguely because every day we get a new Chinese company coming into play that's going to be making flow batteries. The technology is simple. It uses vanadium in an acid solution. It's ideal for long duration storage, so capturing renewables, and 4, 6, 8, 12-hour storage. A place that lithium ion itself is not perfectly designed to play. Another use of vanadium, and this is something we're going to be seeing more and more of, particularly in Europe, is the use of vanadium in the lithium ion cathode structure. And as that becomes more and more relevant, with mainstream players, particularly in Europe, taking up the baton here, we will see increasing demand and interest in vanadium in that space. So for us as a company that's about to develop a new project, we are very mindful that our core market is vanadium and steel. And a secondary market, which is a growing market of great interest to the world, is the vanadium battery market. Just a quick outline of the project itself for those who don't know where we are. We're in Western Australia, one of the best places to do business in the world. From a mining point of view, we have extremely high standards. Sometimes those can get in the way of some things in terms of timing, but at the end of the day, they allow us to operate in a secure environment. When our customers, especially for critical minerals, are in the allied countries, in Europe, North America, and in Japan and Korea, we have an opportunity there to provide a guarantee, if you like, on the opportunity around Australian projects and how they will be delivered. So it's sort of an inherent good place to be. It's also not always true that Australian projects are going to be more expensive than other projects. So in our particular case, we are able to utilise the excellent internal gas resources of Western Australia to bring our project into the lowest cost quartile of production. So just outlining who we are, a strong technical team with a very strong vanadium experience globally. We are focusing on a cost curve, putting ourselves on the cost curve at the lowest position possible, so we can survive all price cycles of this vanadium market. We're currently completing a bankable feasibility study. We have strong support from the Australian government as a major project and as lead agency status in Western Australia. The fact that the vanadium as a critical mineral is very much on the map, not only as a battery mineral, but that critical mineral nature, and I mentioned earlier the use in defense applications, means that it's really, really important for projects like this to get up and to produce their product, their high purity product within Australia at the highest possible purity level, with value addition taking place here within the country. Now, this is entirely possible with the resources and the infrastructure that's at our disposal in Western Australia at the moment. With our experience base, sorry, can you just go back one slide quickly? Just remembering again that we have a product in the vanadium market that is a reinforcement steel product that is in world demand and has an additional benefit of carbon dioxide emission reduction as a standard product. Importantly, again, the battery market is a development. So all of those things together, we can move to the next slide. culminate in the fact that we've completed our second pre-feasibility. So we did a pre-feasibility in 16, and we've updated that in 18, and we've updated it at the end of 20. That second updated pre-feasibility was to bring us in line with an updated resource reserve, which currently stands at just over 30 million tonnes, giving us a mine life of 25 years. That is an initial mine life, with at least another 10 years of unclassified resources in terms of their reserve status available to us to add in. We have identified a strong financial outcome from that project, given the low operating cost and the revenues we see. And we've used a very modest price here. As an organisation, we're fairly conservative. We're not looking to shoot the lights out here. We are looking to make sure that we build something that will last. To your comment, Warren, you want something that your children will be proud of, and that'll be standing in 25, and your grandchildren can still go and get a job at in 25 to 30 years. Now, other vanadium projects around the world in countries like South Africa have been there for over 40 years, and that's the sort of asset we want to build. The important thing here is you have to get your operating cost in the right place. And again, the resources, the available infrastructure, particularly with respect to gas in Western Australia, is a game changer for this project. Just a quick look at the geology section there, without getting into too much detail. We are focused economically on that little high-grade horizon at the base. That section is typical of the entire 87 million tonnes in that resource, and in fact typical of the entire total resource, where the higher horizons, the green and the yellow and the blue, constitute our waste material, but they're actually about 0.5% of vanadium, higher grade than most people's resource grades. So our reserve grade is very much in line with other producers in South Africa and Brazil from primary production. And our intention is fully to get this project banked and ready to build by the end of this year, and with the purpose of being the next vanadium project off the ranks in the world to support this growing growth. So just a flick to the next slide, please, to summarize. What are we doing this year? We are very active on social media, so I invite people to look at us on social media. Oz Vanadium is our Twitter code. We're very active there. We don't only post about ourselves, we post about the vanadium industry generally. We have a subsidiary focus on the battery industry called VSun Energy. VSun Energy is also on Twitter, and also worth following up if you want to educate yourself around vanadium redox flow batteries and where they're being implemented around the world. So we're big sharers. We love to share what we're doing. We share with our industry and what our colleagues and partners are doing around the world, because we believe that not only we're in some core businesses here that are really exciting for investors. So from an investment point of view, what to look forward to, the company's a number of MOUs in place. Our MOU strategy is not purely Chinese, it's Chinese and European, North American. We believe there is significant offtake in those areas that can be serviced. We are working on those to lock them down as we finish the bankable feasibility study, which is taking place around the middle of this year. It's underway at the moment, and we're moving rapidly through the detailed work of costing to maintain a strong financial position in the company, which we currently have, but also to start spending the rest of this, the last quarter of this year and the first 2 quarters of next financial year in Australia to qualify our financiers for the project, both from a debt and equity point of view. The project, I said, looks very, very peachy on paper, and technically it's got a lot of supporting data behind it. So we're inviting funds that want to play to come and give us a call and get stuck in. We're inviting investors to get on the market and take advantage of the extremely low prices that we currently have on offer. Social license to operate and environmental approval are a core operation of our team as we move our way through. We just initiated a gap analysis by ESG consultant at Vincent to bring us in line in terms of our bankable feasibility study. And we enjoy the ongoing support of federal and state governments in Western Australia, for this critical mineral. And we intend to utilise that good support, which is currently taking the form of a number of different types of things, including grant funding and support funding to get us over the line. So that's AVL in a nutshell. I look forward to any questions. We're not here to mess around. We're here to get things done. We also understand that things need to be done properly. So we are working our way through the technical, financial due diligence phases one must do to make sure that you build something for the ages, as Warren said earlier.
Okay, thank you very much for that. And perhaps just before I turn to Cathy, we can just make sure we have Cathy Moises unmuted. So I guess my sort of kind of question to bring in like kind of Cathy from Argonaut Funds. I imagine that you must have covered vanadium for obviously like a lengthy period of your career when you're when you're obviously involved in stockbroking. So I was wondering, is question for you: do you have any thoughts about vanadium? And also then a follow-up question is, do you have any like questions that you'd also like to go and ask Australian Vanadium and Vincent?
Vincent, I really enjoyed that presentation. I do like vanadium. I think it's it has some very clear uses. I mean, it's great to have a core use on top of the battery use. So you've got that that backup. But I guess looking at your market cap, which I just did at 67 million, and looking at your NPV of 900 million odd, clearly you've got quite a major capital funding requirement. Just interested, you made the comment on the government funding. I'm actually on a few different boards myself, some in the critical mineral space, and certainly we've been very, very happy with the government support we're getting. But if you'd like to quantify, I guess, the split between debt and equity, and particularly what sort of expectations on government funding. And I guess the other one is, again, kudos to you guys to get 100% offtake at this early stage. What's the pricing element of the offtake? This vanadium isn't a metal that I'm as familiar with in terms of the aftermarket.
Yeah, so just to answer those two questions, remind me if I lose my way in the response, Cathy. So in the first instance, the current model we're using, which is a detailed model that we developed in the course of the second PFS, puts us at about comfortably at 50, but more like 60% in terms of debt equity. Capital cost is 400, and that's just everything in a box. That's a very it's a detailed estimate in terms of cost, but it's what a project of this size would cost. It's a roasting and water leaching process. So we've got to put a big kiln in, we've got to make a concentrate. So, but this is a project we're going to be building for a 25 to 30 year life and beyond. We've actually chosen to split the project, Cathy, to put the processing plant closer to the coast. So not only will it be able to support its own feedstock, but other feedstocks down the line as well. So we're giving that project itself a much longer life, even beyond the ore body that'll be feeding it in the beginning. So we're looking at 60-40 in terms of our ideal market is a 60 debt, 40 equity on a 400 million capex, which put us in an equity position of under 200 in terms of equity required. And with a market cap of 60 and those milestones to come, I feel comfortable that we can get our equity up, value up around the 100, 150, 200 mark, which would enable us to match that. So that's my target, and it means it's not a 400 million equity I've got to get to somewhere halfway. So the other thing about that is getting cornerstone support, obviously both equity and debt along the way. Now you mentioned the government debt support. So NAIF obviously is a good start, but there's other ECA funding in there as well, both from foreign government ECA funding who are interested in supply of equipment, offtake of materials, and then we have the Australian funds themselves. So NAIF, for example, has done 2 primary debt deals in the last little while, one for a potash project, one for a mineral sands project. So we're seeing that there is an appetite to take the bigger chunk of some of these critical mineral projects and put them into the government coffers, if you like. I think the hurdle there is going to be that the due diligence is quite stringent, which is why as a company we're focusing on a very, very conservative approach to that technical and financial due diligence. We do have to still get work done on the equity value side, but we're doing that by degrees, making sure we keep delivering on our milestones and showing the value of the project. The offtake side, to get to your next question, I think sorry if I said we had locked in 100% of offtake, that we've got a number of MOUs in place to do so. We haven't locked them in on paper, so by contract. But just in terms of pricing, we are working with parties that are good counterparties, parties that can have a balance sheet and are known to be able to deliver into their markets, preferably parties that are not trading our commodity, that are actually buying it and using it, so end users, or at least very close to end users of the commodity. And also those contracts are going to be hinged on a take or pay style arrangement confirmed. So we want to make sure, A, we know where our material is going and we know what the pricing point. In terms of vanadium pricing, the long-term average vanadium price is around $8.67 per pound, US. That's what it's priced at. We'll be producing around 22 million pounds of material every year, and 24 million pounds, sorry, I'm just looking at my own slide, 24 million pounds a year. Our operating cost is around $3.66, so there's a reasonable margin built in to the very long-term average price of vanadium and our operating cost. So pricing from an offtake point of view is normally pitched for us slightly higher than our operating costs, so we have a built-in margin. And if the other party is looking to insist on capping, we want that capping to be up around the midpoint of the highs, and that can be around $12 to $15 a pound. So giving ourselves plenty of upside in those deals, but not making sure we're accelerating the upside significantly when the price does move. The price is volatile, but the most important thing is to cover our downside on those pricing deals.
Okay, bringing in Warren, do you have any questions for Vincent?
Thanks, Andrew. Vincent, just a quick one. Again, in a previous life, I bought the Niobec niobium mine in Quebec, which wound up to be a huge win. Obviously, owning and operating a niobium mine, we learned a little bit about vanadium, because vanadium and niobium are somewhat similar. Their main markets are supplying into the steel specialty business, but they do have these odd little uses. You know, niobium is found in MRI machines and various high-tech applications. So some very sexy applications, but the price is set, and 99.9% of demand is from the steel industry. So you're not dealing with General Electric, you're dealing with Bow Steel. And that's who you're contracting with. Vanadium has, again, similarly, some very sexy uses, the redox flow batteries, etc. Can you give me a feel as to, despite the attractiveness of those future markets, in the next year or two, how much of vanadium demand comes from the steel industry versus other applications?
Yeah, so that's been a consistent 90 to 92% over the last 20 years. It's probably been higher in terms of steel application, and that continues to be the case. So Warren, I think what we're seeing is a growth of around 3 to 4% in that continual use. That's coming from Chinese markets, from other steel markets where steel markets are developing. So people are using vanadium in higher grade rebars. So there's an interesting distinction you make between the use of niobium and the use of vanadium alternatively. Niobium is currently a monopoly in the world. There's only one company producing niobium in a large way, and they control the price. They're producing almost all of it. CBBM, I think, is the company's name. And they they control the price. They can set it exactly where they want it to be. So when it goes into the Chinese market, they can move the price around to where it suits them. Companies that make steel and use vanadium, when the price differential is against them, in other words, when the vanadium price goes too high, they can switch back to use niobium. But they can only do that, most importantly, in certain grades of rebar, because as you get into higher grades of rebar, especially larger diameter rebar, you can't substitute that with vanadium. You can't substitute niobium for vanadium in that case, because you get problems with the precipitation of certain things in the steel, and that's a well-known fact that the Chinese market has understood. So there is a place where niobium does replace vanadium, but there is also in the higher strength steel and the larger diameter rebars, a place where it does not. And that's where we're seeing this 3 to 4% growth continuously across the Chinese market. The Chinese market does control the price. The Chinese rebar market, grade 3, does control the vanadium price. There's no doubt about that. And that demand has been off the charts in the last 12 months as the Chinese got through COVID and just barreled forward. So they've been taking off all the vanadium supply from Africa and Brazil and filling their boots with it and making their steel. So as the world wakes up in the West, that supply is going to go back to Western producers, and the Chinese are going to be short. They can't just switch on new vanadium production because it's coming out of their steel mills, and those steel mills are at full capacity right now. So we see a growth curve, and I think I've just looked at the recent numbers in the steel market. That Chinese demand growth for vanadium has gone up by 5-6% this last 12 months. And that's also because the Chinese markets have insisted on regulatory in use of vanadium in microalloyed steel. They can't get away from not using it. So there's a natural uplift there. It's about 3 or 4% overall, and it will continue to go in that area. Another big upside is countries like India, countries in Southeast Asia. They've got a steel mill growth where new vanadium is going to be needed to service those steel markets. Now that vanadium simply does not exist. It'll be consumed in China or it'll be servicing Western markets. So there's this need every 3 or 4 years for a mine of our size to bring new vanadium into the market. And if that doesn't happen, we're going to see what happens in the vanadium price every now and then. It just gets out of kilter and it shoots up. It does get substituted at the top end. We know that. And that's where the vanadium battery comes in handy. New consumption, which is large volume like a vanadium flow battery, can start to level that off. It's a totally different industry. It's energy. It creates a different dynamic in pricing, in long-term contracting, and you can start to see that price level off, which is what our objective is. It'd be great if we had a vanadium price around $8 or $10 that was just like it all the time. We'd love it, just like the niobium price.
Okay, thank you very much.
That answers your question.
Yep, no, that's good, Vincent. Thank you.
I think we've just got time to squeeze in one more question from the audience. Vincent, which of your 2 locations has the resource you described on your slide? Is it the one near Meekatharra or the one near Geraldton?
Yeah, so the mine and the concentrator plant are near Meekatharra, and then the material is transported by truck to the processing plant, which will be near Geraldton. The reason being is that's where the gas is. That's where we get much lower price, low risk gas to ourselves, and we can help get that operating cost really low.
Okay, thank you very, very much for that. I think with that, we are actually dead on the hour and we are out of time. So all that remains for me to do is to thank our guests. So to thank our investor guests who were Warren and Gilman and Cathy Moises, to also thank our sponsors who were Vincent Algar of Australian Vanadium, as well as Blair Sargent of Celsius Resources, as well as our media partners, the Resource Global Network. See you next time. Until then, stay safe. Thank you very much.
Thank you. Bye-bye.
Yeah.